You're listening to the We Are Libertarians podcast network. Find all of our shows at wearelibertarians.com.
Lowe's knows how to help you get the most out of your store run. That's why members save more with My Lowe's Rewards. Earn points towards My Lowe's money on eligible purchases. Get access to member-only deals and free member gifts. Plus, unlock free standard shipping when you reach Silver Key status. So what are you waiting for? Join for free today. Lowe's. We help. You save. Loyalty program subject to terms and conditions. Details at lowes.com/terms. Subject to change.
You know what's smart? Enjoying a fresh gourmet meal at home that you didn't have to cook. Meet Factor, your loophole in the laws of mealtime. Chef-crafted meals delivered with a tap, ready in just 2 minutes. You know what's even smarter? Treating yourself without cheating your goals. Factor is dietitian approved, chef prepared, and you plated. Pretty smart, huh? Refresh your routine and eat smart with Factor. Learn more at factormeals.com.
Before we start, I want to thank all of the Weird Libertarians patrons for being a part of the show. You can find out all of the benefits of subscribing on Patreon at joinwalplus.com. That's WAL+.com. You'll get bonus content, access to the complete archives. There's over 1,000 shows that you can't get in the public feed, and you'll be supporting all of our great shows. Thank you especially to our $100 a month members, John Pusilo, Vincent Peichel, Lars Nordskog, Jake Edel, Matthew Durbin, Reinhold, Christy Avery, and Jason Doolittle. We also want to thank our main sponsor for this episode. It is Iconic Insurance. 15% of Americans are left to find health insurance on their own. And even if you get health insurance from your employer that doesn't work for you, Matt Allen and Iconic Insurance can help you find the right insurance. Just head over right now and contact him at iconic-insurance.com/libertarians. We'll put the link in the description if you can't remember that. But Matt is a longtime listener of this program and a great guy and a good friend of mine. So please go support him and reach out right now. Thank you. And now let's get started with our show. You're listening to the We Are Libertarians podcast network. Find all of our shows at wearelibertarians.com. Welcome to the Chris Spangle Show. Thank you so much for being here. I am excited to be here with you today. We have a returning guest. His name is Jack Salmon, and he is uber intelligent, and he understands economics far better than I ever will. And it's our pleasure to have him here explaining something that I've kind of been curious about. We're raising interest rates, but what effect is that going to have on the economy? Jack is a Young Voices contributor and a writer on economics. His commentary has been featured in a variety of outlets, including The Hill, Business Insider, RealClearPolicy, and National Review Online. Jack, thanks so much for coming back on the show. We really appreciate you being here.
Thanks for having me back, Chris. I'm glad to be here.
Yeah, so tell me, how did you get into economics? Like, what fueled your fire and made you want to get into this particular topic as a research area?
It's a great question with quite a long background, but it really started in high school. I was curious about economics, and so I took an economics class, and my teacher at the time was an ardent trade unionist and a socialist, and I just thought it was very narrow, sort of tunnel vision view of economics. And so I discovered Milton Friedman, and I started reading Capitalism and Freedom, and I loved challenging her and getting her upset in class, and so it sort of spurred an interest in economics for me, and I went on to study it at college, and I've always loved it.
That is very similar to me and a poli-sci professor I had in college during the Iraq lead up. I was a good little bushy back in 2004. But that seems to be like a common theme amongst libertarians and conservatives and people who kind of are of a free market mindset of like, you know what, I went to college and then they just said a bunch of stuff that didn't make sense, and I really just needed to disagree with them, and I didn't know how. So I went and looked it up. Do you find that to be like a common thing amongst other people that you talk to?
It is, and I've heard it quite a lot in my circles that people felt disheartened when they were in college, or they felt that they had been singled out because they felt that they thought in a slightly different way. And I think that just pushes people further towards sort of opposing ideas of central planning and top-down organization, which is a great thing.
Absolutely. I think being sort of having a gut feeling this isn't right and going back and looking it up, it's a great great training ground. So you had an article in National Review that caught my eye on Halloween, a very spooky article it's titled "How a Decade of Low Interest Rates Fueled Reckless Government Spending." Now, I don't know a ton about interest rates, so let's start there. Like, define what an interest rate, and when I see there's a 7-point or 3-point increase in the interest rate, what does that mean?
So there's two different types of interest rates we can talk about here. There's the interest rates that are the federal funds interest rate. So that's the interest rates that the Federal Reserve sets on its reserves. But those rates will actually have an impact on all interest rates, whether it's private. So it could be loans that you have, it could be credit cards, could be mortgages, car loans, but also the public sector. So it affects the government's finances. The government, as it rolls over its debt, it goes into either lower interest rates or higher interest rates, depending on which direction they're heading in. And the issue we have now is that we've been in a situation of sort of artificially low interest rates for really over a decade, since the great financial crisis. And so policymakers have been in this mindset that we're always going to have low and steady interest rates, and so the future is very predictable. And because of this, they continuously racked up larger and larger debts, because they could just roll over the newly maturing debt into low interest rate debt, and so the cycle continues. The issue there is we now ended up with a huge debt, most of which has very short-term maturities. What I mean by maturities is when the Treasury rolls over its debt, it can either choose to buy long-term debt, so debt that it wouldn't have to pay back for 30 years, but the interest rate would be higher because it's longer term. Or they could choose to roll it over into short-term debt, which could be a year, 2 years, 3 years, and the interest rate would be much lower, so it's much cheaper to do that. So because rates have been so low for so long, they've rolled most of our debt into short-term maturities. So we're now in a situation where 50% of our debt matures in 3 years or less. 30% of our debt, now that's $24 trillion. 30% of that $24 trillion matures in the next year, in the next 365 days. Now, that is a problem when interest rates have gone from effectively zero to about 3-4% where they are now. We're talking about trillions of dollars. And so
I'm guessing they're going to roll that into something else. They're not obviously going to be able to pay that, let alone pay it. So do they then roll that into more short term? But you're saying the problem is that it goes from, I really think maybe my entire adult life, the interest rate at the Fed has been around zero from, when I graduated during 9/11 to now. So they just keep rolling that over. Do they keep rolling that into short term? What consequences does that maturation have? Maybe the first question, let me ask you. So when they buy these bonds, is it treasury bonds or what do they actually buy to float the debt?
So these are treasury bonds, and there are all kinds of buyers of treasury bonds. International central banks buy US treasury bonds. The Federal Reserve buys treasury bonds. Investors buy treasury bonds. If you're an investor and you own a bond fund, it probably has treasuries in there somewhere. Pension funds will buy treasury bonds. So they're really sort of a liquid asset that floats around the market. But they would roll over into short-term treasury bonds typically when interest rates go higher. But what we've seen this year in particular is interest rates spiking across the board. The issue is the shorter-term treasury bonds are more sensitive to changes in the Federal Reserve interest rate. So because the Fed is now hiking rates upwards to 5%, that's impacting the 1-year, 2-year, 3-year treasuries far more than it's influencing the 10-year, 30-year. So they really have no cheap option to roll over into. And so all the debt they carried over during 2020, when interest rates were effectively zero, they're now having to put those into treasury bonds with interest rates of 4% and up. And so I anticipate this year, 2023, I tend to track the federal budget. I anticipate the interest payments on the debt this year being about the same as the entire defense budget. That's how bad it's going to be.
Holy cow. And that's always sort of the go-to libertarian line of, well, we can cut the defense budget and let's save money there, but that's very unrealistic in terms of how the overall picture of the federal budget is. So what does this mean for your average listener that may be listening going, all right, this sounds scary, but how does that impact me?
Well, in the private sector, it means that private loans are also going to be suffering from higher interest rates. So if you have credit card debt, it's going to affect you. If you have a mortgage, it's going to affect you. If you're planning to buy a new house, it's going to affect you. Car loans, it's going to affect you. But on the public sector side, the effect of increasingly costly debt, it means that capital is going to be crowded out. So there are only a limited number of investors in the marketplace. They either choose to invest in private companies or they buy government bonds. Now, because the interest rates are going up, people are seeing government bonds as being a more attractive investment. I don't know if you've heard of savings bonds. It's just one of the treasury bonds that the treasury issues, but they've been offering 9% interest rates. So people are not investing in companies. They're not investing in the private sector because of these huge spikes in interest rates. That means that there's less business growth. It means there's less jobs available. It means there's going to be less wage growth in the foreseeable future. So it's going to start hurting people in those terms. So there's that effect on the private sector. But then the issue from the public sector perspective is it's going to worsen deficits. It's going to worsen debt sustainability, which means it's going to increase pressures on government to do things like raise taxes. So that's it. It's really it's a lose-lose situation.
Which then decreases the amount of money that there is to pay more in salaries and for further investments, which creates less job growth, which creates less private sector capitalization.
So one of the big risks there is stagflation, which I think we could be moving into an environment of stagflation in the next year or two.
Can you explain what that is? And talk about Japan. I'm not an expert on Japan, but I've heard Japan thrown around as an example, both for and against more government spending. So it's one of those anomalous countries that I'm always baffled by. Well, I mentioned that because they have famously been in stagflation, and I'm about 20% through a book called The Lost Generation about an entire generation of young people in Japan who just never had the same amount of economic opportunity as the high growth of the previous two generations, and it was largely due to the concept of stagflation. Now, I should have just said, please explain stagflation to me, so my apologies.
No, it's fine. And they used to call it the lost decade, but Japan really now it's been 3 decades of essentially zero growth. The government there has racked up such a large debt. I think the last time I looked, it's something like 260% of GDP is their total public debt. Ours is 100, and that's already problematic, and it's causing issues. And they've also been living in this fantasy that they can keep rolling over the debt because of low interest rates. By some miracle, they haven't yet seen a spike in interest rates in the same way that we're currently seeing or that we saw in the 1970s and 80s. But that doesn't mean we should put all our eggs in one basket and follow suit. It's really quite terrible. And what they've seen there is since about the mid-90s, there's been effectively zero wage growth in Japan. There's been effectively close to zero economic growth. They tend to cheer, Japanese government ministers cheer when they see 1% growth. So it's really quite a depressing sort of utopian situation to be looking at. And it's not something we should be looking towards mimicking here. Because I often hear some economists say, well, Japan's doing just fine. They have a huge debt and they seem to be doing fine. They're definitely not doing very fine. You only have to speak to a young Japanese worker and you'll very quickly find out it's quite problematic.
What explain that? What do you hear?
So one of the arguments that I hear sort of in opposition to my arguments against racking up more debt is that there is no threshold level whereby which our debt starts to become damaging economically or starts to hurt us in that sense. And they always point to Japan and they say, well, Japan's been racking up debt for 30 years They reached 100% of GDP. Nothing bad happened. The world didn't end. They reached 200. The world didn't end. But what they're really talking about is they're talking about the risk of a fiscal crisis, something like what we saw in Greece in 2010. I'm not saying that that's definitely going to happen here in the US, but the situation in Japan is arguably worse than what happened in Greece. A sort of slow kill is far more painful than a sharp fiscal crisis. I would rather have a sharp fiscal crisis and then have fiscal consolidation and try and get our house in order in a short period of time rather than a sort of 30-year drag of stagflation.
Yeah, that sounds like you can't buy a house. Your wage doesn't grow, but inflation grows. I mean, we've kind of there's that famous chart that you always kind of see on libertarian meme accounts, right? Of when we're taking off the gold standard, and inflation goes up, but wages just kind of flatline, and that this sort of feels like that's where we've been and where we're going, and it's very frustrating because people don't really know how to fix it. So how do you start to fix this? How do you start to unwind this?
The inflation or the debt? They're two very big obstacles. They're very different.
I think a lot of people get those two things mixed up or think they may be the same thing, right?
Well, they're certainly interrelated,
right?
And they bring their own risks. One of the things I'm worried about, talking about the sort of intersection between debt and inflation, is that as the debt gets larger, policymakers, the sort of people in control of the fiscal apparatus, so the spending and taxes, they start putting pressure on the central bank. We call this fiscal crisis, fiscal dominance in economics. It's where the Federal Reserve would essentially lose its independence because policymakers would put pressure on them to keep interest rates low, to keep the cost of financing debt lower into the future. And so that's a risk that comes with racking up more debt. But where inflation comes into that is if we saw a spike in inflation and we had a huge debt, there would be reluctance to tackle the inflation by raising interest rates because they wouldn't want to spike the cost in debt servicing for those fiscal authorities. So you have a sort of clashing of heads there. And that's a real risk that we face if we keep racking up debt.
Can I ask why do they raise interest rates to tame inflation? And does that work?
So well, first you have to look to the underlying causes of inflation. In 2020 and in sort of the early part of 2021, there were some supply restraints which are inevitable when you shut down and when the government forces a shutdown of the entire economy. You're going to have some sort of supply chain capacity recovering over time, and so supply was down, and that drove up prices temporarily. But what ultimately happened was we had a $700 billion output gap, which means that our economy was about $700 billion below where it should have been looking at pre-pandemic trends. And rather than spend a small amount of money to sort of close that gap or to allow the private sector to close the gap, which is what they should have done, they should have unleashed the private sector, they decided to spend $2 trillion. And so not only did we close that gap, but we overshot the gap, we overheated the economy, we put trillions of dollars in excess savings in people's pockets. And so it was, in the end, it was demand that really caused the inflation spike that we saw in 2021. And so where the Federal Reserve and the hiking interest rates comes into this is they have to raise the cost of consumption, of taking out credit, of spending to bring down inflation back to sort of sustainable levels. So in simple economic terms, to bring back demand to supply. To bring it back to equilibrium.
Yeah, so it has to be more expensive for you to put things on a credit card, to buy a car on credit, to buy a house on credit, to slow down the amount of spending in the economy so it starts to dry some of that up.
So the fiscal authorities in Congress caused the inflation, and now the monetary authorities are going to have to crash the economy to try and bring the inflation down, which no doubt will then lead to fiscal authorities saying, oh, well, now we need stimulus.
Right.
And the cycle continues.
So I see that a lot of people preparing for 2023 and an economic slowdown, a recession, you say crash the economy. I think that's a scary phrase for a lot of people who are kind of unaware of what's going on. How do you think the next year or two plays out economically for just your average person? Start with the macro and then work down to the micro, I guess, is the way to ask it.
Yeah, I don't know that I can speak to sort of on the very micro individual level, but I suspect the soft landing that we keep hearing about is kind of out of question at this point. I don't see that happening. I saw a study released by Larry Summers, who has actually been fairly good throughout this sort of inflation surge at making certain predictions and making calls. He was opposed to the American Rescue Plan as well very early on. And he thinks that the unemployment rate is going to have to go up to about 6.5% before inflation comes back down to trend. So that's something that I think is certainly possible in the next year or two.
I think it's at 2% right now? It's very, very low, right?
Yeah, it's something around 3%, I think, around 3%, a little there above, roughly where it was back in late 2019 before all the madness happened. But so I think there's some risk of slightly higher unemployment, nowhere near what we typically see in a business cycle recession, but 6-7% is certainly on the books, and I think another risk that comes is that we don't actually get inflation back down to 2%, which is something that I'm increasingly starting to worry about. I think once we get it down to about 4%, there might be some reluctance to go any further, and so we end up shifting the target, and that's something that I'm worried about now. Having a 3 or 4% inflation target. So
to put it in other words, we're at what, 8%, 7% inflation right now.
Yeah.
And that roughly, for anybody who doesn't understand, that roughly means inflation is what? Is the amount of money that's in circulation, or the overall cost?
You could see it. So it's essentially the easiest way to describe it.
Jack spends so much time thinking about this stuff that this is very difficult to explain to him, who's someone who got a C in Mr. Early's economics. I could see it in his face, but I warned him ahead of time. This is Econ 101, buddy.
So too much demand and too few goods is the simplest way to describe it. But you can also describe it in monetary terms. A monetarist interpretation would be that you essentially print money, and so you devalue the currency, and so it's the amount of devaluation on an annual basis in the currency is a sort of monetarist interpretation.
And really, for 20, 30 years, we've had 2% inflation, and it's been like setting your watch to it. And so why so many people are having trouble right now is in their industry, they may see 15% inflation. And so they priced out 2%, 2%, 2%, 15. Oh man, we're way underpriced. Raise the prices. And so if we were just to stay at 4% inflation, what does that do to the economy long term?
So my key fear with raising the target is like you quite rightly said, since the 70s, 80s, we've set 2% as the target. And it's not just in the US, it's also in my home country of the UK, we have a 2% inflation target. All over Europe, pretty much every advanced economy in the world has a target either at 2% or somewhere between 1% and 3%. And so there's a fairly strong consensus. So this has anchored expectations. So every consumer sort of is either aware that we typically have about 2% thereabouts inflation every year, or they just don't care because inflation is so low and so stable that it's not something that they worry about on the day-to-day basis because it's 2%, it's close to zero. The problem with having 4% is it's far more visible. It could unanchor people's expectations, and they may think, well, if they can double the inflation target to 4%, why not 5? Why not 6? And so it creates a lot of uncertainty. It shifts people's expectations, and I think that could create a lot of volatility within the economy. And I think that's a real risk that we shouldn't be posing.
And consistency is like the key. Right? Like predictability, especially for businesses and for your household, right? When you go, I go to the grocery now for $150 worth of groceries and it's $220, right? That predictability is very dangerous. So I know it's very, very unkind to ask for predictions, but When you say there's no soft landing, like, do you think it looks like 2008? Does it look like the Great Depression? Like, I think give someone a sense of, like, work's going to slow down, jobs are going to slow down, it may be harder to find a job, or dig up the silver, start selling it now. I'm just kidding. Give us some idea of what that means for a slowdown in the next year.
So I don't think it's going to be anything like 2008 or something like that. That was a fairly deep recession, and then we also had a very slow recovery. It's going to be something similar to what we saw in the early 80s, hopefully not quite to that extent. We're going to have to hike interest rates. The Fed is going to have to hike interest rates to about 5% and then probably hold them there for a year or two. That's definitely going to cause an economic downturn. Whether or not you call it a soft landing or a hard landing is still in question. I'm leaning towards hard landing. But we're already starting to see layoffs happening in the tech sector. So I've seen some companies announcing, and it's not just Twitter. I've seen some companies announcing layoffs of 20% of their workforce, some tech companies. And the reason we're seeing tech companies go first is because they're the ones who have, number one, benefited the most from the years of low interest rates. And number two, they sort of had an artificial spike in employment during
these companies have never made profit. They're like the perfect example of the American economy of we always predict growth, so we always just take out credit, and we're always running over margins and run deficits. And like I don't know if Amazon's ever made a profit.
Zombie companies in economics. That's also another huge problem they have in Japan. About half their economy is essentially zombie companies. But the other reason tech companies are the first ones to start to see layoffs is they saw an artificial bump during 2020 because of everybody going remote, and all these companies suddenly needed to employ thousands of IT workers, and so it's those companies that sort of helped get people through those months when everybody was essentially at home most of the time, whether it was delivery services or using Google Meets or whatever it was. So those companies really saw an artificial growth in their labor markets during that time, and that's now starting to come back down to reality, combined with the spike in interest rates. So I think we're going to see more layoffs in the non-tech sector as we move into 2023, but I don't think it's going to be as painful as previous recessions. This isn't a business cycle, a typical business cycle recession. This is really a Fed-induced recession. And so I think it's slightly more manageable, but it's not going to be, I don't think it's going to be a soft landing.
We're not going to hold you to it either way, but we appreciate your insight and your education and having you on. It's always great to talk to you, Jack. You always you give me something to think about that I just don't spend a lot of time reading the intricacies of this stuff, and it's really fascinating to see how these macroeconomic policies impact us on a daily basis, whether we think about it or not.
Yeah, I'm always glad to come on and help try to explain this. I'm always explaining these things to different audiences, and so I'm glad to have these discussions. I really enjoy it.
Well, thanks so much, Jack. Shameless self-promotion time. Where can people follow your work?
You can follow all of my work, all of my interviews, my articles, and if you're interested, my Twitter handle, it's all on my Young Voices bio page under Jack Salmon.
All right, we'll link that in the show notes. Thanks so much, Jack. We really appreciate you coming on the show.
Thanks, Chris. Have a good one.
Thank you so much for listening to The Chris Spangle Show. If you learned something, if you found this interesting, then the best thing you can do is share it with your friends and family. Word of mouth is how your favorite podcast grows, and we are no different than that. So thank you. We will see you again soon, and we'll talk to you again next time.